Bitcoin ETF flows have flipped direction again, and the reversal is not dramatic in headline size, but it is significant in structure. Just weeks ago, spot Bitcoin ETFs were recording persistent net outflows, reinforcing a narrative that institutional demand had stalled. Now, the data shows consistent net inflows returning at the same time price volatility has compressed and funding rates have normalized. That combination creates a contradiction. Retail sentiment surveys remain cautious, social engagement metrics are muted, yet capital is quietly reallocating back into regulated Bitcoin vehicles. When positioning and sentiment diverge from capital flows, it is usually worth paying attention. Let's begin with the data. Over the past several trading sessions, aggregate spot Bitcoin ETF flows have shifted from net negative to net positive. The magnitude of these inflows is not euphoric. They are measured, consistent, and spread across multiple issuers rather than concentrated in a single fund. That matters. When flows broaden across issuers, it suggests allocation decisions are happening at the portfolio level rather than through tactical short-term trading. Volume has increased modestly, but not in a way that indicates speculative excess. At the same time, derivatives open interest has stabilized rather than expanded aggressively. This is not leverage chasing price. It is capital entering with balance sheet discipline. ETF flows function as a transmission mechanism between traditional capital pools and Bitcoin's underlying liquidity. Pension allocators, RIAs, multi-asset funds, and treasury managers cannot, in many cases, hold native Bitcoin directly. ETFs provide compliant access, daily liquidity, custody clarity, and operational simplicity. When net inflows resume after a period of outflows, it often reflects internal rebalancing cycles, not emotional reactions. Institutions rarely buy breakouts impulsively. They accumulate into weakness or during consolidation when volatility is manageable and liquidity depth is sufficient to absorb size without slippage. Now consider the broader liquidity backdrop. Dollar liquidity conditions have been gradually easing relative to prior tightening phases. Treasury issuance remains elevated, but short-term funding stress indicators have softened. Real yields have stopped accelerating higher. Risk assets broadly are stabilizing rather than expanding. In that environment, Bitcoin behaves less like a speculative tech beta and more like a liquidity-sensitive macro asset. When global liquidity stops deteriorating, Bitcoin's downside volatility tends to compress. That compression provides institutions with a more favorable risk entry profile. Liquidity cycles drive Bitcoin more than narratives do. When liquidity expands, marginal capital searches for convexity. Bitcoin offers asymmetric upside because it is scarce, globally tradable, and increasingly institutionalized. When liquidity contracts, Bitcoin becomes a source of volatility to be reduced. The recent ETF flow flip suggests that large allocators no longer see immediate liquidity contraction risk. They may not be aggressively bullish, but they are repositioning from underweight toward neutral or slight overweight exposure. Another layer to examine is positioning in derivatives markets. Funding rates have cooled from prior extremes. Perpetual swap premiums are modest. Options skew shows less aggressive demand for short-dated upside calls compared to earlier speculative phases. That indicates retail is not chasing aggressively. When retail leverage declines while ETF inflows increase, the market structure improves. It reduces the probability of cascading liquidations and increases the probability that price advances, if they occur, are driven by spot demand rather than borrowed capital. Institutional behavior is rarely about predicting immediate price targets. It is about managing exposure across cycles. Consider risk versus reward asymmetry. From current levels, downside risk for Bitcoin in a neutral liquidity environment may be defined and measurable, perhaps tied to macro shock scenarios. Upside potential, however, remains structurally open-ended due to supply constraints and reflexive adoption. When allocators see asymmetric payoff structures with improving liquidity stability, incremental positioning becomes rational even without a strong bullish catalyst. Retail investors often misinterpret ETF flows. They assume large inflows automatically precede explosive rallies. That is not how allocation works. Institutions scale in. They do not deploy full position sizes in one session. They adjust exposure over weeks and months. Retail psychology, by contrast, tends to oscillate between fear of missing out and fear of collapse. When flows turn positive during low excitement, it often reflects patient accumulation rather than speculation. We should also consider macro correlations. Bitcoin's correlation with equities has fluctuated, but liquidity sensitivity remains consistent. If central banks signal steady policy without aggressive tightening, risk assets can maintain stability. Bitcoin does not require rate cuts to perform. It requires the absence of escalating liquidity stress. Recent macro data suggests stabilization rather than deterioration. That backdrop reduces the probability of forced de-risking among institutions. There is also the matter of supply dynamics. ETF vehicles absorb spot Bitcoin from the market when they record net creations. Those coins are typically held in custody, effectively removing them from active circulation. Over time, Persistent net inflows create structural demand pressure. This is not immediately explosive, but it is cumulative. When retail eventually re-engages, it competes with already reduced liquid supply. Psychological traps remain present. Retail participants often wait for confirmation in the form of rapid price expansion before entering. By that point, risk-reward deteriorates. Institutions prefer the opposite approach. They add exposure during periods of skepticism because volatility-adjusted entry improves. The current environment resembles quiet repositioning rather than momentum chasing. That difference is critical. Risk scenarios must be acknowledged. A sudden liquidity shock, whether from unexpected inflation data, geopolitical escalation, or credit stress, could reverse flows quickly. ETF capital is not permanent capital. It can exit with equal speed. Additionally, if Bitcoin fails to hold key structural support levels, systematic strategies may reduce exposure. The presence of institutional participation does not eliminate downside volatility. It changes its character. However, opportunity scenarios are equally clear. If liquidity continues stabilizing and ETF inflows persist at a measured pace, Bitcoin's supply-demand balance gradually tightens. A moderate catalyst, such as improved macro clarity or renewed corporate treasury adoption, could amplify price response due to reduced available float. In that case, upside acceleration would be driven by spot absorption rather than leverage expansion, creating a healthier rally structure. From a positioning perspective, smart money may be signaling three things. First, extreme downside probabilities have diminished in their models. Second, Bitcoin remains a portfolio diversifier with asymmetric return potential. Third, waiting for perfect clarity often results in inferior entry points. Institutions do not require certainty, they require acceptable probability distributions. If you found this breakdown useful so far, consider subscribing. The goal here is not prediction, but disciplined analysis of how capital actually moves through the system. Let's return to flow mechanics. ETF creations require authorized participants to source underlying Bitcoin. That sourcing can tighten exchange liquidity if inflows persist. On-chain data shows moderate transfer activity consistent with custodial consolidation rather than speculative churn. Exchange balances have not spiked significantly. That suggests coins entering ETF custody are not immediately re-entering circulation. Another important observation is volatility compression. Realized volatility has declined compared to previous expansion phases. Lower volatility reduces value at risk constraints for institutional portfolios. Many funds operate within strict volatility thresholds. When volatility declines, allocation capacity increases mechanically. This can generate incremental demand independent of directional conviction. Retail mistakes often stem from over-reliance on headlines. When outflows occurred, many concluded institutional interest was fading permanently. In reality, outflows frequently represent rebalancing after strong performance. When price appreciates, Bitcoin's weight in multi-asset portfolios increases, triggering trims. That mechanical selling can appear bearish, but is often neutral in intent. The recent inflow flip may simply reflect the next rebalance cycle. Risk versus reward asymmetry also interacts with time horizon. Institutions think in quarters and years, not hours. Short-term drawdowns are tolerable if long-term convexity remains intact. Retail traders often operate with leverage and tight stop-loss thresholds, making them vulnerable to volatility. That structural difference in time horizon creates repeated transfer of wealth from impatient capital to patient capital. Macro influence remains central. If real yields stabilize and dollar strength plateaus, Bitcoin's macro headwinds diminish. It does not need aggressive monetary easing to appreciate. It needs stable conditions that allow risk tolerance to persist. The current macro landscape, while not exuberant, is less hostile than during peak tightening. In summary, the flip in Bitcoin ETF flows is not a dramatic signal of immediate upside, nor is it a trivial statistical fluctuation. It represents a measurable shift in capital allocation behavior. Institutions appear to be repositioning during a period of reduced volatility and stabilized liquidity. Retail sentiment remains cautious, leverage is moderate, and structural supply absorption continues gradually. The risk scenario involves renewed liquidity stress that could reverse these flows. The opportunity scenario involves steady inflows, tightening supply ahead of broader participation. The precise takeaway is this: when ETF flows turn positive during low retail enthusiasm and stable macro conditions, it often reflects strategic accumulation rather than speculative excess. The question to consider is whether you are positioning based on price emotion or based on liquidity structure and capital behavior. If this analysis adds clarity to your framework, subscribe and continue the conversation.